evening, all. Ira Epstein with your financial market wrap-up, and this wrap-up is for the first trading day of 2023, Tuesday, January 3rd, 2023, 6:46 p.m. Central Time. So good to be back. I know you missed me over the weekend. I just decided to stay in my robe and take it easy. And no, I don't go out for New Year's. That's amateur night. We watch that very carefully. But now I'm refreshed, back to the marketplace, and there's a lot to talk about. You know, there's events that you have to categorize for the year. Probably what's Russia and Ukraine going to do? The wars are going to expand, biological, nuclear. How do you reach a peace? What's the off-road? Taiwan, China. Will China make a move on Taiwan? They know the sanctions that would hit them. What would take place? I don't foresee that the U.S. would get into a real combat role over it. I don't think Europe would either. And China knows that, but the trade that they'd lose would be tremendous, and the sanction costs are overwhelming for an economy trying to come back. And of course, then we have the world looking at the potential of recessions coming in via central bank tightening everywhere. Now that puts us into this week, which is very important. We get jobless claims and the U.S. jobs report this week. Super important. Why? Because the day that the FOMC meeting takes place in February is February 1st, which means these are the reports for jobs that the Fed is going to have to deal with. How will they look at them? Well, if you get big breaks in them, the Fed's going to feel good about everything. And the analysts that are saying 25 basis point hike will be at the next meeting, they're going to feel very good. What changes all that is if these reports are no more than a wobble. In other words, a slight reduction or no reduction, that could always be the case. And that has to keep the Fed back to the 50 basis points, if not higher, depending on other reports that'll come out all month long. Certainly, we want to see what inflation is doing. Has it peaked? Is it wobbling? Is it coming down at a good pace? There's a lot to be decided this month. So for traders making this first trade day of the year, I was laughing as I saw the market up at first hard and then drop real hard. And I kept telling people around me, it's not going to stay down hard. It's going to come back because at the end of the day, the selling's taken place. And sure enough, you had a lot of that in the market. The other interesting event was the dollar super strong today, up over 100 points. And yet you're able to get gold up. And I thought that was very important. So gold didn't care that the dollar was super strong for one day. Very important there. Energies all got hit. Grain markets got hit because the strength in the dollar is very, very important, of course. And then recession ideas. As each month goes by, that recession idea, especially as central banks keep raising rates, weighs on the market. So when we take a look at a weekly area chart of just closing prices, you've got here the market sitting and going by the fact of you've got the difference here, 385, 38, 56, 60. I said that so wrong. 38, 56, 62 is the 18-week moving average of closes. The market is under it, so the bias is down. If the market were over it, I'd have an upside bias. It's a filter on how I think the overall market is doing. I then step to the daily charts. And as you can see, we've come down and we're just sort of churning right here. Are we trending? The answer is no. First, you had an outside day down. For those of you who have taken my outside day course, you know that means that in reality, this market over the next 48 hours should have a very difficult time of getting back over the highs of today. And the high of today was 39.07 and a quarter. So I would view the market as that is going to be the difficult spot. Where's the bias of the market? It's down as the market is under the 18-week average of closes. In fact, in this chart, you have a classic bearish setup. The shortest moving average, the red one, which is the 18-day, is underneath the green one, which is the 100-day, and the green is under the 200. It's a classic bearish setup. If the market takes out today's high, the next resistance would be 39.35, the 100-day average. Could that set the market back into an uptrend? In reality, it could. You might be able to argue then that you get rid of this low that you made today and the market's going to fight for direction. It would be, at best, an ugly chart, at best, a difficult one. What about downside? Well, the next downside target in the market is the lower Bollinger Band, and that comes in near the 37.56 level. Do I think this is a great setup? No. Here's what I think it was. Looking back at it, I think if you go back here around December 20th, and that's about where it was, it's hard to believe, but that was the Santa Claus rally just into the 18-day average of closes and a failure. Pathetic? For sure. Did the Grinch come out? For sure. Would you call it a failure rally? I would, but I can't get away from the fact that the market did work its way back to that 18-day average and failed there. When I come and I look at the momentum, I have embedded readings. Embedded means that you've got the the slow stochastics going sideways under 20. Now, you can't count today, Wednesday. It is Tuesday, I know, but we're in Wednesday trade. So you go to Tuesday, both numbers under 20. You come to the day before, Friday under 20, and the day before. You've got your embedded reading. Until the red line closes now over 21, I contend that these rallies are being sold by the pros looking for the potential of the lower Bollinger Band and or a window envelope. I don't show the window envelopes here. It'd be too many lines. Plus, I want my subscribers to have things the freebies don't get. When we look at the NASDAQ, you have your embedded reading. So another outside day down. If you take out the high of today, either on Wednesday or Thursday, well, that could mean we're going up to the area here of 11,298. But right now, the pros on these rallies, I think, are going to go short until the embedded reading is lost. I don't think they'll play that game in the Dow. And by the way, in the Dow, you also had one of these patterns that if you take it from here, mid-December, you began a rally that went right to the 18-day average. Pathetic Santa Claus rally. At best, pathetic. Could be worse words. But the market went there and it ran into its brick wall. It now has to decide the next move. And the identical thing happened in the Russell. Again, not embedded here. So I don't see anything there. It's the markets I showed you were the ones I think that are going to get sold. In the VIX cash, we have higher lows, higher highs. Now, you can't get away from the fact that the VIX, the whole month of December, just basically was trading against the 18-day average of closes, either side of it, not doing a lot. 2290 is the next resistance. When we come to the bond market, you got up and over, right here, the 20 level. And as we take a look at that, you can see you got lower highs, lower lows, resistance 128.14 to 128.5. Fighting there, rallies that get there, and they could get there. Did we have an embedded reading? So let's get away from today's action. And if I could, it's not going to let me. I don't know why. It's decided on this chart to not do that. Let's see if it'll do it here. No, the stochastic name is moving. But if it had an embedded reading, is it going to lose it tonight is going to be the big question. In the 10-year notes, you had your embedded reading and you're losing it tonight. So this could be more of a rally in the bonds and the notes that could carry back to the 18-day average. Do I think it'll go much beyond that? I don't. I think that this is one of these big breaks into the Bollinger Bands. You're getting a bounce, and I don't think it's an overall change of the bearish picture in the market. When we come to the dollar index, you went down last Friday, challenged the lower Bollinger Band, and soared today. What do I teach you each time that we talk? When you have a market that attacks either an upper or lower Bollinger Band, doesn't matter to me which. The first challenge of it, if you're not with an embedded reading or where the pros come out. Does it have to be the exact number? Well, it's a zone. Ideally, it's that number. And I think thin holiday conditions, a lot of people came out. Do I see a trend in the dollar? I do not. I see a lower low, higher high, a market in the near term of this month of January now starting to grope. Which way does it want to go? If it rallies more, look for resistance wherever the Bollinger comes in. It's 104.31. That'll drop tonight, though. In the euro currency, it's the flip-flop. So in the euro, what happens, see, I can't change those parts, but you had the higher high, then the lower low, right into the Bollinger Band Friday without an embedded reading. Short covering, the bounce now, don't know what it means. I don't see a trend there either. I am bearish in the pound. The market has the embedded reading. I think the pros are waiting to go short this market up into between here and the 200-day average, looking for even a lower low on the market. I'm wrong, and I think the trade would come out of shorts if this number closed over 21. When you look at Bitcoin, we saw the trial dates theoretically get set for Mr. Fried, and what will happen there is an October trial. That gives you the better part of this whole year where everybody's just going to be fighting back and forth. The prosecutors will decide how good of a case they have. The defense will go through buckets of money trying to prove whatever they can. At the end of the day, it's all about how long a jail sentence. That's really what it is. Everybody'd be better served because it's our money. Getting this man to cooperate, getting whatever money's left, get him in jail for whatever time, and so be it. But it won't work that way. When you look at Brent versus WTI, you're back down and fighting the battle here. Now, you can call this a ratio chart, an area of chart of difference. There's many ways to look at it. When you divide one by the other, it's a ratio chart. When you subtract the differences of the two, then it's a price differential chart. And in the Brent, we're at 82.33, just to show you this, and 77.10 in the WTI. Now, it's February versus March, admittedly, but it's not a ratio. The other chart's the ratio, not the difference. And I'll get that name right. Somebody wrote me about that. You are 100% right on it. Higher high, lower lows. I don't see a thing to do in the Brent. WTI, same thing. Notice where the market failed, up in the upper Bollinger Band area and threw itself right back after being overbought. We're waiting for new trends to set up. That's where you're at right now. First week of January, let them set. Heating oil came scooting on down pretty good too here. Look at that big failure. And what numbers did it fail against? The gray line's the 200, the 100-day average. How often do you hear me say the combination of those and a Bollinger Band, pros come out at those numbers, and that was right on the money. Now in the nat gas, we are slipping back down. This market's the never-ending bear market. That's the only thing I can say about it. It's hard to believe you're trading under 4. We should see these benefits in America is at least our natural gas prices aren't going crazy. But it is time for you to start thinking about springtime gasoline prices. Now, what I'll do soon is I'll be adding gasoline to these charts, maybe replacing one of these because it's getting to be important. And you want to watch for the bottom because you typically get a great rally opportunity between now going into June. And I'd be looking for that very hard if I were you. And as I said, one of the things I like to do is give you ideas. And the place I do them, and I know you think they're here, it's not here. It's in my morning subscriber videos for both futures and ETFs. It is there that you get to see trades unfold. I'm recording charts. I can go back and forth live data at the time that I'm recording them, giving you how the trades are setting up, what I think for short-term, longer-term trades, the fundamentals, where I think they're going. My morning videos are typically about 17, 18 minutes long. On the bottom, if you go to our website and view them, and you have to be a subscriber to do that, there's a scroll bar. So let's assume you wanted to go to interest rates for whatever reasons in spiders or futures. Just go to that area of it. Energies, it'll take you there. Or you can watch the whole thing and you get an education every time because it's not about, hey, here's a chart, here's what I think, it all gets confusing. I make it easy. Why? Because I unfold the chart. I can go back a day at a time, days at a time, and I show you what I'm seeing. Am I going to be right on the trades? I'll have my share of being right. Am I going to be wrong? I guarantee I'm going to have losing trades. Nobody walks on water, but it's about money management. And most of the time, we're in pretty good shape on that. Can markets get away from any trader? Occasionally. You've seen it. Do you think Tesla didn't get away from traders? Take a look what's going on. I mean, that's what you see all the time. So if this fits your bill, it's perfect. Why? 5:30 in the morning, I'm recording on the futures. That's AM Central Time. That's out just after 6 p.m. for the traders. Then at 9 o'clock, I start recording for the Spider ETF and the stock guys, and I cover a lot of stocks. My specific recommendations are going out. As a subscriber, you also have the right to write me what markets you want covered. Sometimes I'll do an individual chart just for you. Takes me a minute or two. I'll make a video of it and I send it to you. I devote a certain part of each day to people that write in about that. Some of you want me to do things that don't make sense, like the FTSE. Okay, I see no purpose. There's a FTSE in all the different markets of Europe with stocks. You're not going to be trading it through most of your stock accounts here. Got to trade in foreign currency. So there are things I'll avoid. Other people asked me to cover Costco just recently. So if you watch tonight, you're going to see that when I do my Spider ETF, I'll lead off with Costco. I listen to what I think makes sense, and then I alter. And we alter throughout the year, so we don't get stuck with just the markets you're looking at. How do you take advantage? Go to our website under the word research. It's all laid out there. Choose the package you want. They're very inexpensive. You get a very big discount on the first 30 days to add to that, and you decide if you like it. Can it be simpler when you don't want it? Right in our member login area, you control your subscription. You can add on. You can switch to a yearly. Any way you want to go. I'm Ira Epstein. Hope you take advantage of all this. Have a great new year, and I'll see you tomorrow.